Hello everyone, welcome to CPA Exam Lab. Today we are going to discuss about balance sheet and the statement of financial position. This is one of the first topics, if not the first topic we all study when we start preparing for the FAR section of the CPA exam. It is a very common form, we all know about it. Today I'm going to give you some examples, some of the multiple choice questions or simulations where they can come from. And also show you some of the exam traps you might encounter. Let's get started. Okay, the balance sheet, also called the statement of financial position, gives us a financial snapshot of a company. This document shows the financial condition at a specific point in time. Sometimes in the exam, especially in simulations, you may not get the whole information, but the document, it may show you something like December 31st or at specific point of time. This is the balance sheet. That's the biggest difference between the income statement. That this is the one other very common statement they like to test. For the income statement, it covers the period on time. So what does balance sheet cover? It gives us three things. So balance sheet basically tells us what the company owns, our assets, our liabilities, what the company owes, and the remainder, which is the equity. This is basically the financial equation you may all remember. The first thing we all learn, assets equal liabilities plus equity. So basically the balance sheet shows this, and the name balance comes from the accounting equation. Everything has to balance. Everything on the balance sheet is driven by this equation. This is the first thing we learn. Assets are equals to liabilities plus stockholders' equity. One trivia information, this is not going to be asked in the exam, but you might question, where does this double entry bookkeeping is coming from? So it is actually coming from Renaissance era. Mathematician called Luca Pacioli. He writes a book, and there's a chapter in his book that talks about double entry bookkeeping. The logic is every transaction affects at least two accounts. So we can give an example here. So let's say we have a company, and in our company we have our assets, they are equals to 100K, and we have 70K liabilities, and our equity, the remainder is the 30K. So let's say we purchased a car and we got a loan for that. So what happens is we bought an asset, let's say it's worth $50,000. Our asset increased to 50,000, so it became 150. But because we got it as a loan, our liability also increased 50K, so our liability became 120, and the remainder equity is also 30. Another example, let's say maybe we got $40,000 of that car as a loan and $10,000, like we used our own money. Then the equity this time it would be 110. And this would be 4. So in the end, everything is going to balance. Now let's move into the definitions. This is one area that the exam likes to ask. So it is very unlikely that you are going to get a question about the accounting equation, but you might very likely get a question about the definition of assets, liabilities, and equity. And for this one, they usually question the specific terms, the definition. So here we have SFAC 6 definition, assets. So what is an asset? Basically, assets is a probable future economic benefits obtained or controlled by a particular entity as a result of past transaction or events. I have an accent, I hope hearing it is not very boring for you, but I'm going to split into several groups. So what does it mean? Or the question would be, what is considered an asset? What do we need to look in order to say, okay, this thing is an asset? So there are a couple things we need to look at. Number one, the asset must give us a probable future benefit. For example, in the earlier example, I said we bought a car for $50,000. The car gives a benefit for the company. Here we say probable because Maybe there's going to be a theft tomorrow or the day we purchase the car. It's not going to happen. But if we run the balance sheet at night, it is going to be on our books. The second thing is control. Pay attention here because control is key. If we bought a car for $50,000 and we got a loan for it, the legal ownership is still with the bank or whomever gave us the loan. But it is still our asset because we obtained it. We control it even though we do not have the legal ownership. The third thing must result from a past transaction or event. This is the one they like to trick you. So let's talk about the executory contracts. So those are the contracts where neither party has performed. Because no past transaction has occurred yet, this is not considered an asset. Okay, so let's go to the liabilities. Liabilities also has a definition. They are probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services. What are those? So we have a probable future sacrifice. What does it mean? And either give up an asset, which is a cash, or provide a service. This is an unavoidable obligation. This has no discretion to avoid the sacrifice. This creates an obligation that has already occurred. You can always check the date of the underlying transaction. Based on this, you can see if a present obligation exists. Let's say you receive an invoice for services on December 28th. You have a liability on December 31st, even though you do not pay it until January. This is something you might see in the simulations. Always check the documents of the dates. Okay, let's look at the third piece, which is the equity. It's the residual interest. It's a key definition from the SFAC, which they like to test. Shareholders only have a claim on the company's assets after all the creditors have been paid off. The residual nature is why creditors have priority over shareholders during liquidation. Equity is not a primary claim, it is always secondary to liability. This reinforces the equation we discussed earlier. There are three different ways the balance sheet can be presented, and the CPA exam likes to question you that. What are those? The number one is the account form. This one you may remember from your books. Here we have the assets on the left, liabilities and equity on the right. This almost looks like a T account. Number two is the report form. This is the most common form that we all see on the exam. Also, if any of you work in the tax business or to clients, this is the one the accounting software prints out. And the third option is the financial position one. This one is more used by the IFRS, International Financial Standards. So basically, this one starts with calculating the net working capital and emphasizes liquidity and solvency. Like this is less likely you would see on the exam, but sometimes they like you to do conversions between international standards to the gap. Okay, so the account form, this is the classic horizontal presentation. It visually reinforces the accounting equation because you can see on the left-hand side assets, liabilities, and equity on the right-hand side. This is great for teaching fundamentals. That's why you may remember this from your accounting textbook. But it is not very commonly used for the financial statements because of the space constraints. This version of presenting is not less than the other formats, but like the usually gap, we prefer the second one. This one is an exam tip. If you're ever asked to verify if a balance sheet is correct, you can quickly create and verify everything. The report form is this is the standard one. You may be very familiar with this one. It basically lists all the assets first, then we calculate the total, then list the liabilities and shareholders' equity. Here you can also see that everything balances. Do you see that everything is still the same, just the presentation changed? One exam tip for this form: if they do not specify, you can assume that they want you to use this form because this is the most common one. Okay, now let's go to the third one, the most analytical format is the financial position form. If you stop and analyze it, you can see that it immediately highlights the company's liquidity. Basically start by calculating the net working capital, which is the current assets minus the current liabilities. This is crucial for the short-term health of the company. Then we non-current assets and subtract non-current liabilities to arrive the total net assets. Here the key takeaway is that the total net assets must equal stockholders' equity. This format shows how the company's long-term capital structure supports its operation. The exam may use this form to test your understanding of working capital. So the final figure, the total asset, is basically another way of expressing the residual interest of the owners. Now we are done with the formats. Let's dive into the specific classification rules for assets, and let's start with the current assets. Okay, so we covered the balance sheet formats. Now let's dive into details of the classification, and we are going to start with current assets. Those are very important, not also for the balance sheet, but also for the liquidity ratios that we are going to see later. So what is a current asset? This is a well-known definition. Those are the assets expected to be realized in cash, sold, or consumed within 1 year or the operating cycle, whichever is longer. And this is one topic that we all know, that what is a current asset, but we always forget the operating cycle, and the exam likes to ask that. So let's say if a company's operating cycle is 18 months, and then if they have an asset convertible within 18 months, it still goes as current. But for most of the companies, they usually stick the 1 year rule. The most common ones are here: cash and cash equivalents. What are they? Currency, demand deposits, and short-term liquidity investments. They will mature in less than 3 months. Our short-term investments, they are available for sale, expected to and sold within 1 year. Accounts receivable. Accounts receivable is a current asset, but net of allowance for doubtful accounts. Inventories, it's a current asset. It is reported at lower of cost or market. Prepaid expenses are payments made in advance for services, what could be maybe the prepaid insurance, prepaid rent, and they are current. We classify them as current if they are used within a year. Example, let's say maybe we have a prepaid insurance expense for 3 years. So anything the next 12 months is going to be a current asset. Okay, we are moving from short-term to long-term, which is our non-current assets. Those are the resources that provide economic benefits beyond 1 year or an operating cycle. Logical. So we break them into 4 different categories. The first one is our long-term investments. Those are the investments held for strategic purposes, not for quick sale. One example could be maybe like the land held for speculation, which exam likes to ask. Our special funds, such as like a pension fund or sinking fund, would be included to that. The second group is the property, plant, and equipment. What are these? Those are the tangible assets used in the operations, and we must remember that they are always reported net of accumulated depreciation. So those are always reported net of accumulated depreciation. Of course, there's an exception here, which is the land. Why? Because we do not depreciate land. The third one is the intangible assets. What are those? Those are the assets like patents and goodwill. They are non-physical but valuable for the company. Yeah, I cannot change the pen. Perfect. And finally, the other assets. So this is basically catch all for the miscellaneous long-term items. That could be the long-term prepaid expenses, deferred tax assets, or non-current restricted cash. Okay, now let's move to current liabilities. Just like the assets, we classify liabilities based on 1 year or the operating cycle rule. What are current liabilities? Those are the obligations that require settlement within that short-term periods, typically requiring the use of current assets. The most common example we can think of are the accounts payable, accrued expenses, unearned revenue, and the most critical part is the concept there's a current portion of the long-term debt. This is the portion that you may see in the exam. They love to ask this one. So basically, any portion long-term debt that is due within next 12 months becomes the current liability. One other thing is the short-term notes payable also in the current liability. Okay, let's move to non-current liabilities. Those represent the company's long-term financial structure, meaning they are not due within next year. Those are bonds payable, long-term notes payable. Probably the most common one you may see is the mortgage payable here, where the promissory notes mature more than a year. Lease liabilities, the same way, those are the obligations, lease payments greater than 12 months. For lease liabilities, it recognizes both finance and operating leases. We have a catch-all section, which is the other long-term liabilities. Those are the pension obligations, deferred tax liabilities, and asset retirement obligations. Not very common even for the CPA exam. Here's a key concept. If a company violates a covenant, long-term becomes current. Basically, it becomes callable. In the exam, they're not going to tell you current, but if they say callable, it becomes current. One other key takeaway from this slide is that the same thing applies from the previous slide. As long-term liability approaches maturity, you must classify the portion due within next year as current. Okay, so we are in the stockholders' equity section. Just to repeat the definition we had earlier, stockholders' equity is the residual interest. Basically, it is the amount left for the owners after all the liabilities are paid. It has 4 sections. Those are the contributed capital, the amounts invested by the shareholders. This includes the capital stock, both par value or additional paid-in capital. The second one is the retained earnings, the cumulative net income or loss retained in the business after all the dividends are paid. So you can see from the name the earnings that are retained goes here. The third one is the treasury stock, which is the contra equity account. Basically, the shares repurchased by the company. One real life example you may remember during 2020 and 2021, when the interest rates were very low, a lot of companies purchased their own shares, so it goes on their balance sheets. I think Meta was one of them. It goes as an equity account in their shareholders' equity section. And the non-controlling interest, this one is reported in the consolidated balance sheet, so it's basically the equity subsidiary not attributed to the parent company. So maybe let's say the parent company is Alphabet, Google's parent company, and they have many of those child companies. One thing I want you to pay attention, and we are going to have a separate class for this, but basically the accumulated other comprehensive income, those are the gains and losses not yet in red income. For example, unrealized gains on available for sale securities, or foreign currency transactions. This bypasses the income statement. We just covered the components of equity, but now let's cover something that almost guarantee that you are going to see something in the exam, which is the treasury stock accounting. It's a little confusing and they like to test it. A lot of students think that treasury stock goes to an asset, and the logic is very simple. You say, okay, the company paid its own money and purchased a stock. So normally when you purchase a stock, it goes to the asset section. But in this case, because it is the own company, like the company ABC buys the stock of the company ABC, they cannot own itself. So like those stocks the company buys becomes dormant. Those stocks do not have voting rights, they do not pay dividends. Maybe they keep more control inside the company. Maybe the company thinks that the stock price is going to increase, so they want to buy it. But basically, because of those reasons, it goes to the equity section, but it goes also as a contra equity because it is not an asset. So how you can see it in the exams, all you have to do is move it to the equity section. Treasury stock is a contra equity account, therefore it is going to be in the debit section. When we move it to the equity section, we have to reduce the total equity because equity increases on the right hand side as a credit. This is a little confusing. We are going to do a couple examples here. If you cannot remember anything, just remember that treasury stock is a contra equity, it is debit, and it is shown in the equity section of the balance sheet. Now let's address the broader presentation rules of offsetting. So this section is like the logical, we all know it, the offsetting is usually not allowed. We must show the gross amount. We cannot net accounts receivable against accounts payable and show only the difference on the balance sheet. Everything is separately shown there. However, there is a rare exception and the exam likes to ask that. You may see like the derivatives and the repos, which is called the right of set-off. So what is that? So basically, if those four conditions meet in the presentation, we can offset each other. What are those? Number one, they must be determinable amounts. So we know how much each party each other. Right to set off, they have a legal right to each other. They have intent to set off, both party intends that. And the enforceability, like this is enforceable. So one example could be, let's say we have a vendor and we bought a product from them and owe them $100,000. Then maybe we provided a service to them or we returned a service like something like that, and then that created a loan from them to us for $30,000. So instead of showing them separately, we can net each other because all four of the conditions meet here. This one is important because they like to ask it. What if not all the four conditions meet? Can we do it? The answer is no. One easy example could be, let's say you have a deposit account in a bank and you also have a loan in the same bank. Can you offset them? No, because the deposits are subject to insurance. The loans are not. They have different rules. So in the exam, if you see something about offsetting rules, you need to think about the four rules and all four of them must exist. The proper classification of current and non-current items are essential because it directly impacts the two critical liquidity metrics, net working capital and current ratio. Working capital is simply your current assets minus your current liabilities. This measures the dollar amount of short-term liquidity buffer available to the company. And the second one is the current assets divided by the current liabilities. And it measures the ability to pay short-term obligations. Our target is more than one. For example, if the number is 2, that means for $2 of every asset, we have a dollar liability, so we are healthy. If it's the other way around, we have more liability than the asset, which is not healthy. The exam usually tests your ability to calculate these metrics and interpret the results. The one key takeaway here, the high ratio is good, but also excessively high ratio can suggest that inefficient use of cash or inventory questions. Now let's do a practice question. We have a Summit Corporation and they've reported some account balances at the year ends. So at a particular date, remember it is the balance sheet, and they're asking us their total assets. Okay, so let's go over one by one. Cash. Cash is an asset, so we have $60,000. Accounts receivable is also an asset, $25,000. Treasury stock, remember I told you they always like to put it there, and we all think it is an asset, but it is not. It is a contra equity account we are not putting there. Property, plant, and equipment, it is also an asset. Accounts payable, it is a liability, it does not go there. So we have 60,000 plus 25,000 plus 20,000, and the answer is 205,000. Here we have another question for liability. On December 31st, year 1, PEX Industries has 2 million note payable. It is due August 1, year 2, so less than a year. They intend to pay the note using the cash from operations. Since it will be settled with the current assets, which is the cash, it is going to be current liability. Okay, now let's do another question that is about refinancing and how it affects the liabilities. On December 31st, year 1, Titan Manufacturing has an $800,000 short-term note due March 1, year 2, so in 3 months. We have a note due, which is our current liability. However, on January 20, year 2, before statements are issued, Titan refinances the note with a 5-year loan. So they are basically asking how they should be classified on December 31st, year 1 balance sheets. Here we pay attention to, okay, so we see that January 20, year 2, they refinance it before the statements are issued. So this could be a little confusing here, so think this way. The balance sheet date gives us the snapshot of December 31st. But most of the time in companies, there are a lot of moving parts. It takes time, sometimes weeks to get the balance sheet ready. So basically here they are telling us we are going to prepare the balance sheet for this company after January 20. By the time we were preparing it, we knew that we already refinanced it. So how are we going to report it on the balance sheet? The answer is the non-current liability, because under the US GAAP, the short-term obligation can be reclassified non-current if the company has an intent, which they did, they wanted to do it, and they have ability to refinance it, which they demonstrated by actually refinancing before the financial statements were issued. This is one of the trick questions, but here they meet all the conditions. Now, let's go over the common exam errors and the traps. The first one is the treasury stock. It is not an asset. It is a contra equity account, a negative equity account. If you see a treasury stock, think about it, it goes to a contra equity. The second one is a restricted cash. So you may see questions that talks about the restricted cash, and usually we think it's a cash, so it's a current asset. But if it goes to a bond sinking fund or it is restricted for some other purposes, that means we do not have access to it, so it is not a current asset. The other one is the bank overdraft. That's basically about the offsetting. So you may see more in the simulations. If there are bank overdrafts in the same bank, same account, you can use the right to offset. Most of the time, you are not going to see that. So they are current liabilities. I consider overdrafts as current liabilities unless there is a right to offset within the same bank. The other one is the refinancing intent. The previous slide, remember the company had a $800,000 current debt, but they were able to refinance it before the balance sheet date. So we moved it from current to non-current. Sometimes they do not have both intent and the ability to refinance it is not shown on the exam, so make sure that you see both ability and the intent to show it. The balance sheet doesn't exist in a vacuum. It's a part of fully articulated set of financial statements. And understanding this connection is crucial for the CPA exam because it helps you to verify your work and understand the flow of information. The most direct link is the income statement. Net income is the primary driver that flows into retained earnings on the balance sheets. The statement of cash flow is also directly connected. The ending cash balance of the cash flow statement must perfectly match the cash line item on the balance sheet. Finally, the statement in the changes in equity. This reconciles the beginning and ending balances of every equity account in the balance sheet. This interrelationship called articulation, this ensures that all the statements are internally consistent. So if your numbers don't tie out, you know that you have an error. This is a great way to check your work on the exam, especially in the simulations. And that could definitely mean passing and failing for you. Okay, we covered a lot of grants. Hopefully you learned a lot and you feel ready to take some of the multiple choice and simulations. One thing remember, the exam does not test your knowledge. It in the end tests your ability to take the test. There are certain type of questions being asked and you should understand if there's a trick, what kind of trick and how to solve it. It is a process. I know it is not an easy one, but the reward is also very good. Good luck on your CPA exam. Thank you.